Have you ever just stared at a stock chart, watching those lines spike up and then dive down and just thought to yourself, what is actually going on here?
Right. Why do they move like that? Well, it turns out it's not just one thing. It's actually this fascinating mix of forces all working at once. So let's break it down and build a really clear picture of what makes these prices tick. To get our heads around any of this, we've got to start at the very beginning, with the core engine that drives literally every price change you see. And that is the simple but super powerful force of supply and demand.
Honestly, the best way to picture the stock market is just to imagine a massive, non-stop, global auction. Every single second the market is open, you've got millions of people all trying to agree on a price for a company's shares. Some are bidding to buy, others are putting their shares up for sale.
And this is the fundamental rule of that auction. The price you see on your screen, that's just the last price that a buyer and a seller agreed was fair. The supply is all the shares available for sale, and the demand is how many shares people are trying to buy. The entire game, really, is about the constant push and pull between these two sides.
Think about it like a seesaw. If you have way more people wanting to buy a stock than sell it, that high demand is going to force the price up. People are basically competing with each other for a limited number of shares. But if more people are rushing to sell than there are people wanting to buy, that flood of supply pushes the price right back down. At its core, it's that straightforward.
Okay, so that raises the obvious next question, right? What makes people suddenly want to buy or sell in the first place? Well, the most direct factor is the company's own story, how it's actually doing as a business.
Good news about a company, it's like a magnet for investors. When a company comes out and says, hey, our profits are soaring, or they announce some game-changing new product that everyone's excited about, people see a bright future. They want in on that success. That creates a huge wave of buying demand, and boom, the stock price goes up.
And, of course, the flip side is just as powerful. Bad news can cause an absolute stampede for the exits. If a company announces it missed its sales targets, or it's losing money, or even worse, it gets tangled up in some big scandal, investor confidence just evaporates. They start to worry, they rush to sell their shares, and that floods the market with supply, sending the price tumbling down.
But here's the thing. No company is an island. To really understand what moves a stock, we need to zoom out and look at the next layer of influence, the bigger picture stuff, like the economy and global forces that affect pretty much everyone.
I mean, news about the overall economy has a massive impact. Things like high inflation or rising interest rates can make all investors nervous, causing widespread selling. A new government regulation could suddenly help or hurt an entire industry. And of course, major global events, anything from geopolitical conflicts to, pandemics, can shake investor confidence across the entire market, sometimes overnight.
All right, so we've talked about the hard data, company performance, economic numbers. But now we get to where things get really interesting and, let's be honest, a little bit unpredictable. We have to factor in the most volatile element of all, human emotion.
Because at the end of the day, markets are made of people, and people are driven by feelings. And sometimes, the collective mood of investors, the psychology of the crowd, can become a way more powerful force in any financial report.
This is that classic battle between the bull and the bear, right? When the stories you hear are all about people getting rich, that optimism and, let's face it, greed can create a buying frenzy that sends prices sky high. But when the mood turns sour, fear and panic, often fanned by dramatic news headlines and social media, can trigger massive sell-offs, even for companies that are perfectly healthy.
And there's one final layer to add to our picture. Not everyone in the market is reading company news or economic reports. There's a huge group of traders out there who focus purely on the patterns in the data itself.
These traders are all about what's called technical analysis. They aren't really focused on the company's story. They're focused on the story the data is telling. They're looking for recurring patterns in the charts. They're analyzing the volume of shares being traded to see how strong a move is, and they're tracking price momentum. The key thing is, certain signals in this data can trigger huge waves of automated buying or selling, adding yet another wildcard to the mix.
So, we've looked at all these individual pieces, but the real magic and, the real challenge is realizing that they are all happening at the exact same time, all influencing each other second by second.
So let's bring it all home. You've got that core engine of supply and demand, right? And that engine is constantly being revved up or slowed down by all these other drivers.
how the company is actually doing, what's happening in the wider economy, the powerful tides of human emotion, and those technical signals from the traders.
It is definitely not a simple equation. It's way more like a complex, chaotic, and sometimes beautiful dance. Each one of these forces is a different dancer on the floor, and the stock price is just the result of all their movements combined. Understanding that dance is really the key to understanding the market.
And that kind of leaves us with a final thought to chew on. When you think about it, with all these variables in play, from concrete earnings reports to the totally unpredictable whims of human fear and greed, what do you think? Is figuring out the market a matter of perfect calculation, like a science? Or is it more about feeling the rhythm of that dance, like an art? It's a pretty interesting question to think about.